Welcome back. Now let's shift focus to the consumer retail segment, particularly footwear, where the industry is seeing some major trends shaping up. And a latest report from JM Financial says that there has been an increase in demand for sports and athleisure footwear, a higher demand for premium products, and a lot of other trends that it foresees in the future. Now, to discuss more of this, we are joined by Gaurav Jogani, the Director of Consumer Discretionary at JM Financial. Gaurav, good afternoon. Thank you so much for joining in. You've highlighted 4 key trends in your report which are likely to shape up for the future. The one that I wanted to highlight, though, is the premiumization trend. What has caused this shift from mass market to premiumization, and do you feel that most of the incumbent players would have to make a shift to the premiumization bit in order to remain relevant and have their market share intact?
Yeah, hi. Good afternoon, everyone. Thank you for having me. The premiumization shift is on account of 2 counts. One, if we look at the past couple of years, there has been an increase in the GST rates for below 1,000 rupees segment, and which has increased from 5% to 12%. So there is a natural shift. There has also been an increase in demand for the sports and athleisure segment, which eventually lands up into the premium and the mid-premium kind of a segment. So that is also leading to that shift. Now what we believe is that to remain relevant, most of these guys have to offer consumers products which are more relevant to the sports and athleisure category, given that the formal segment is kind of steadily declining at a gradual pace. So that is the reason why we feel that the higher the premium segment for a particular company, the better it is. And in addition to that, if there are more casual and athleisure products, still better than that.
Okay. Gaurav, so this is what's happening with the premiumization bit. I just want to understand how big is the organized market currently? What kind of growth trends are we looking at in the organized market itself? Because you did say that the change in GST rates did lead to some demand shifts as well, right? So what rate are we looking at this particular segment growing?
So the overall, if you look at the organized segment for the footwear, it would be around 35 to 36% odd. The organized segment is expected to grow at around 12 to 14%, anywhere in between that. Whereas the overall footwear segment, we expect to grow at around 7 to 8%. And this will largely be driven by prices and not by volumes.
Gaurav, you have mentioned that you are expecting the footwear segment to grow at a 12% CAGR, the organized footwear to grow at a 15% CAGR. Can you share some of the tailwinds that you have highlighted that would lead to this kind of growth going forward?
The tailwinds being one, if you look at today's India per capita consumption, it's just only 2 pairs per consumer. We expect this to steadily increase to maybe 2.5%, 3% going ahead. And this would be driven by increase in the per capita consumption by the increasing in income. Second thing would be also, nowadays people prefer for multiple footwears. They have a separate footwear when they go out, they have a separate footwear for the sports thing, they have a separate footwear for their in-home consumption as well. So the 2 things that will largely drive this growth will be one, the higher per capita consumption and the higher increase in the incomes from all of these guys.
So these are some of the tailwinds. Are there some risks? Because there was a point in time when the entire industry was facing a lot of pressure. Whenever we had conversations with the management, they said there are still certain things which need to be addressed. So what are those risks to the growth forecast that you have?
So the risk, I would say, one is, the timing difference. So, for example, if we recap to the last year, most of them, kind of have reported muted growth rates. And one of the reason was the year before that, wherein there was COVID tailwinds. People came out of COVID. So the demand was kind of preponed. So that was one factor. The other bit is if your product doesn't remain relevant. So, for example, if there is a higher demand for sports and athleisure segment, however, your product portfolio is more accustomed to, the formal kind of a footwear or maybe more semi-casual kind of a footwear, I think that could be another risk. Third is, I think, the recent risk with the BIS implementation. So, government has implemented BIS from the 31st of August 2024. Now, this BIS implementation would, entail that there would be no imports outside of India from those vendors who are not BIS registered. So in that case, if they are not able to make alternative arrangements or they are not able to get, the sourcing right, that could, in the interim impact the growth rates in the near term.
Gaurav, you have initiated coverage on 3 of these footwear players, Campus Activewear, Metro Brands and Bata. But I wanted to talk to you particularly about Bata because you have a neutral stance on the stock.
Yeah.
And since you spoke of premiumization, Bata has been the one that has been moving towards this premiumization trend from what it has been traditionally known as a mass market player. But the stock has just flattered to deceive. It's been an underperformer for a prolonged period of time. What would it take for Bata now to finally start delivering in terms of share price returns?
So see, one is the top line growth. That is very imperative. So if you look at the last 3 to 4 year CAGR, that has been only 2% top line CAGR for them. One of the bigger impacts for them has been the decline in the sub 1,000 rupee segment. So as you talked about premiumization, the 1,000 plus rupee segment has grown for them even in this quarter at around 7% plus, whereas the sub 1,000 rupee segment has declined by 25%. So unless and until they are able to drive growth in that sub 1,000 rupee price point segment, which constitutes around 30% of the overall sales volume for them, the growth could be anemic. And because it's a high leverage model, unless and until that top line comes in, the profitability would also remain impacted. So I think bottom line would be they need to drive top line growth, and the top line growth will be a function of how they drive growth in the mass segment.
Okay, so mass segment continues to be the focus point, right? Because right now better growth is seen in premiumization. What makes you like Metro Brands and Campus in this case? What are some of the triggers that you think will lead to the upside that you have been penciling in?
So see, Metro Brands, I'll specifically talk about. One thing that they are doing right is, one, they are brand agnostic. They have this unique EBO channel wherein they not only sell their own brands, but they also sell third-party brands. Now, what this allows them to do is that they are able to sell those products which are in higher consumer demands. For example, during COVID times, we saw a higher demand for the sports kind of a footwear, and they were, able to sell those kind of footwear through their stores. The other bit is they are also now tied up with a few good brands like Fila, which is again on the sports and the athleisure side. And very recently, they have also started to open Foot Locker stores, which will give access to the consumers to the premium sneaker kind of a brands, which they were, otherwise not able to have access to. And in addition to that, they are also being robust on addition of stores. So they are practically adding 100 to 125 stores each year. So a combination of all these things again is, driving growth for Metro. And we believe that, that could drive around a 15-16% kind of a top line growth for them and a higher profitability growth given the operating leverage benefits. Now coming to Campus, the past 1 year has been impacted for them because they have gone for this realignment of the distribution channel wherein they are getting the distribution act right, as well as they are now focusing on the open footwear segment, which they were not focusing earlier. They have also now introducing more more value price points, which will help the consumer, to interact with their brand and draw more footwear per person from their brand itself. So a combination of all these things is helping Campus.
All right, Gaurav, thank you so much for sparing time and joining us this afternoon to take us through your views on the footwear market. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned.